what do you think the impact of this quantitative tightening is going to be? Like, how are we going to see it manifest? Are we going to see it manifest in slower economic growth and falling asset prices, or will there be a delay, or what do you think?
Well, first of all, maybe a little bit of history on quantitative easing versus quantitative tightening. Our experience with quantitative tightening is extremely limited. Okay, we had the process between 2016 and 2018 when the Fed did reduce its balance sheet by about $750 billion, which is actually not a lot. It was called, watching paint dry. I think that was Janet Yellen's description back then. So the first thing to recognize there is that quantitative easing is designed to stimulate in a big way. And the way it's made its stimulus effective is by goosing up asset prices, because you get the Tina effect, you get all this liquidity thrown into the system, and asset prices react. You go back to charts to 2009, every time QE ended, we had corrections. Every time new QE was announced, we had big run up in equities. When you had a flip-flop like we did in 2019, even though they didn't call it QE at the time, but they added to their balance sheet. And markets are, let's face it, at this point, trained monkeys. You see the balance sheet go up and everybody races in. In fact, last year, we just had this incredible correlation. Just the S&P was basically just the Fed balance sheet tracker.
Right.
That's the QE equation. QT, on the other hand, is designed to not upset markets. That's the key thing. That's why in 2016 and 2018, it was going so incredibly slow. Also, for context, the Earth is not flat. 2016, 2017, guess what happened? While the Fed was doing QT and rate hikes, the ECB and BOJ and everybody else was expanding their balance sheet. So global liquidity was plentiful. They expanded the global balance sheets of central banks during that time period, actually increased by $5.5 trillion. So don't tell me there was any real quantitative tightening going on at all. Okay,
Great
so
point.
this is all really important to understand. Now, having said all this QT here is going to be the largest that we've ever seen, $95 billion a month, which is less than the monthly QE, right? What's interesting here is that, and the numbers have always been mind-boggling, but just to kind of throw a couple of ones out there, the balance sheet of the Fed has increased tenfold since 2007, right? They were at around 880 billion. Now they got to 9.6 trillion. The reason you see everything pivot off the Fed and markets and speakers is because they are the big 10,000-pound gorilla in the market, right? So what they do with liquidity matters. Now, so far this year, in reality, they haven't done squat yet with QT. They kind of tape it, they stop buying, and it's all glacial. And this is part of the big criticism why the Fed was asleep at the wheel with inflation. A, to be dismissive of it, then to be extremely complacent about it and not reactive to it. If you intervene at every crisis at the blink of an eye, which is exactly what they've done, and then you're faced with an inflation crisis that hurts people, especially the most vulnerable in society, who get hurt the most by massive inflation. And all of a sudden, what? You do not do anything on getting the liquidity back out? No. Because the backdrop, and this is where the market is perhaps right to always anticipate the Fed pivot. If you spend 14 years coddling markets and managing the economy via market direction and always intervene, you've built a construct that is so large that it seems unthinkable that the Fed has suddenly forgotten about this construct, that they're going to throw this all out. Because, and this is just, general basic valuation metrics, all right? Last year, you may recall, I've been throwing my hands up in the air saying, my God, what are they doing with regards to market cap to GDP? Because historically, going way back, 70s, 80s, it was around 40 to 60%. Then it kind of crept up in the 90s. Then we had the tech bubble, got to 155%. At that time, it was the largest disconnect between market valuations and the actual size of the economy. And we had the tech crash, right? And that it bottomed at 75%. And I throw this out here because at the end of the day, somehow you need to have an economy that produces enough that you can back up these equity valuations. When they then intervened, obviously in 2000, 2002, 2003, and then it bottomed, we had the housing bubble, right? That got us around 137% market cap to GDP. And then that blew up and bottomed at 50%, right? We ended last year at 200% market cap to GDP, and it just kept going up and kept going up. And then, you get this thing where things don't matter. And so people say, well, it's different this time, and it no longer applies. It's no longer a good indicator. Oh, yeah? In June, that right-sized to 155%. So ironically, the peak of the tech bubble was the June bottom, right? So, and now there's kind of this thought out there, okay, now the bottom is in. Okay, if the previous biggest bubble is your bottom indicator, you have a lot of trust going forward. You hear a lot about, so many people being short of this, that, and the other. I just looked this up. I posted it on my Twitter feed as well. Equity allocations are still at 64%, which is historically extremely high. Remember last year, there was in 1 year, more money, retail money flowed into stocks than in the 10 years previous combined. And Bank of America is talking about, well, everybody's bearish, but nobody's sold.
Right.
Yeah, they haven't sold. There's been, if you look at just the historic lens, again, assuming it's not different this time, then, we're still vastly extended in the large scheme of things. But then you have stocks like Apple, which almost went flat on the year as if nothing has happened here in August, right? And it has such a big weighting and everybody's comfortable sitting there as a safe haven. Yeah. So to me, looking at all this, and by the way, in July, we went back to 175% market cap, the GDP. Now with this flush we just had, we're back at about 164%. So on that basis, we're still in la-la land, right? That's kind of the thing. And now we're going into quantitative tightening in an environment when everybody kept saying that doesn't matter. I tell you what, it does matter when all of a sudden your cost of carry goes up dramatically. Right. And we've just seen this in housing. I mean, at 2.33% Fed funds rate, which is just slightly above where they were in December 2018. The housing market's already completely falling apart. The monthly supply of houses available for sale is 10.9 months right now. Every time in the last 50 years you get to 9 months and above, you go into a recession, right? And by the way, recession, while Powell didn't use that word, he used an analogous word for it. He said pain. This is as close as you politically can come as a central banker in America. While you have central bankers in England saying recession's coming, while the head of the Bundesbank is saying recession is coming, you're not allowed to say that, apparently.
Right, the head of the Fed can't say that. He's afraid he'll spark a panic and make it a self-fulfilling prophecy.
Exactly. So, there's so many indicators prior to us going to restrictive monetary conditions that suggest a recession is coming, from yield curve, from productivity charts, from the housing market. So now that we're going into restrictive monetary conditions, people try to, again, ignore this because of the rollover in inflation. This is where I go back to the 70s and 80s. The only examples we have of high inflation and a Fed response and a market response. And I've seen a ton of charts this summer that says, inflation rolls over in 1982, and that was the bottom in market. Yeah, if that's your only indicator, and your only variable you're working with, then that's maybe true. What's left out in this example, 1982 or in 1980 or in 1974, is that markets did not bottom structurally until the Fed was already deep in a rate cutting cycle. Why was it in a deep rate cutting cycle? Because the economy was in a recession. It had rolled into a recession. And then they cut, even with inflation still high, right? But the thing is, inflation rolling over is a sign of the economy slowing down, which is obviously what's been happening this year, right? So for the Fed, back to my point earlier, was for the Fed to all of a sudden see easing financial conditions while we're still high inflation is not the solution. Then you run into this Arthur Burns nightmare of 70, where they initially stopped, markets rallied, everybody was happy. Well, then inflation really
got worse. Yeah,
it got worse, and that's interesting. What basically Powell was hinting at by mentioning Volcker 3 times, but not Arthur Burns. He doesn't want to be the next Arthur Burns here, right? So I think we all have to kind of get a reality check here of what the consequences are of now actually restrictive monetary policy going to come. And remember, when these rate hikes come, they have a lag effect. QT will have definitely an impact. Sorry, I kind of went off on a tangent here with regards to your original question.
No, it's all good.
If QT comes in at $95 billion a month, it will have an impact. And I'll tell you why. Despite QT so far having been tame, with rate hikes and rising yields, the monetary base has already been shrinking this year. And I put a chart out the other day on Twitter where I showed the correlation between the directional flow of the monetary base vis-a-vis the S&P. And guess what? Last year, they were just hugging each other. Okay. This year, every time the monetary base dropped, the S&P dropped like a brick. There were a couple of periods when the monetary base was poking up, kind of a little bounce. And we had a big rally in March. We just had a big rally in July into August. Now, the question everyone has to ask themselves here, with the Fed going into restrictive monetary policy, with QT getting fully in gear, what is going to be the direction of the monetary base? So if you think markets can rally happily ever after with the monetary base shrinking, you're playing definitely on the train of it's different this time. Right?
Yeah, and what's also different too from what we saw, years back when the Fed briefly tightened, is that time, as you said, it sort of passed the easing torch to the other major central banks of the world, where they were still easing while the Fed was beginning to tighten. Where this time everybody's tightening.
Not the Bank of Japan.
I shouldn't say everybody. Yeah, neither China.
The Bank of Japan is not tightening. And in fact, I cannot think of a single circumstance now on the planet where in our lifetimes we will ever see the BOJ tightening. Actually, China is easing.
China's easing too. Yeah, I misspoke. But certainly ECB tightening, crazy.
ECB, yeah, but here's again the slowpoke organization, right? I mean, we have record inflation in Europe. We just had 37.8% PPI inflation in Germany, and they're still at zero rates. Right?
I love how they tightened up to zero.
Yeah, they managed to raise rates to zero. Congratulations, courage in our time. Now there's out of Jackson Hole, you saw a lot of very hawkish chatter out of the ECB that they're going to have to be more aggressive in rate hikes, but that doesn't mean that they're going to be real positive. They're all still real negative rates vis-a-vis inflation. And then if you dream of the ECB doing QT, they haven't even discussed it. There was one of them came out this week and it says, well, it may be too early to do it, but maybe we can talk about it.
Yeah, and I loved your analogy about the firefighter.
Yes, exactly. The house is on fire. Maybe
we can't put water on it yet, but we can talk about maybe
we
putting
could
water
talk
on at some
about it.
point.
We could talk. So yeah, that's, you know, and part of the reflection here is just simply the fact that they know Europe is going into a recession. So can you really raise rates into a recession? Now, Isabel Schnabel from the ECB seems to indicate that maybe that's what they need to do. But the notion that all of a sudden there's trillions of new dollars coming into the global liquidity system is a fantasy. It's not going to happen. It's not going to happen anytime soon.
Yeah.
Okay. So while that's helped maybe in 2016 and 2017 for, you know, for the Fed to slowly walk down the balance sheet while these other guys were printing, that's not going to happen this time around.
If you enjoyed this video clip, click here to watch another one you should like.